Hi friends, Simit here from informedtrades.com. In this video I want to talk about financial literacy for mining stocks. I'll be doing a number of videos on this subject. This is the first one. Let's get right in. 4 key points. One is the whole purpose of learning to read financial statements, that it helps us to identify which companies have the most profit potential, which ones are going to be the best, most promising businesses. Investing in those companies will yield us the best returns. The balance sheet metrics that I want to focus on in this video are market capitalization and equity, the cash on hand, current ratio, debt to asset ratio, price to book ratio. We'll define what those mean now, but there's a whole bunch of things we can focus on. I'll be focusing on those in this video. One other point to consider is that value is relative to other companies and to equity. So when you're, or how big the company is. So when you're looking at a company's debt situation, for instance, or its cash on hand, you want to think, all right, how are other companies in the industry doing? Does this company have a really unfavorable debt to asset ratio relative to other companies, as well as relative to its size? So for instance, if a company is small but has a lot of debt, that can be a bigger problem than if a company is larger and has established revenue and profits and has a bit more debt. Also, when you're looking at financial statements, focus on reasons to say no. The best investors tend to be very selective. There's only going to be a small number of companies that generate the huge returns. That's what we're looking for. One of the first tools I use in doing research is Google Finance. It's a free tool. You basically just go to the web page, type in the company's name, and you get a whole bunch of information right off the bat. The first thing I'll look at is the market capitalization, which is right here. Market cap is basically how much it costs to buy every share of that company. It sort of gives you an idea of what the company is worth, what the market has priced it at the current moment. The bigger companies, or the bigger that number is, the more that company is stable and sort of a less risky opportunity. So it's an instant way of assessing the risk profile. Personally, I like to see the 1 billion to 2 billion range in our current time in the mining sector as a sweet spot of opportunities where the company is somewhat stable, but still has a lot of growth potential. When you get down the smaller side of companies that are worth 500 or 100 million or less, there you really see it's a high risk, high reward game where the returns are potentially huge, but it's a bit riskier of a speculation as well. If you click on the left side, you'll see financials, and that takes us actually to the financial statements where we can see all their numbers. In this video, focus on the balance sheet. The first thing you see when you click on the balance sheet is the debt asset ratio. It's just like a person here. When a company has low debt and high assets, that's a stable sign. If a company has a lot of debts and not so many assets, there's a good chance they'll be financially distressed. That can be a negative. In this particular example, McEwen Mining, we see they have no debt and hundreds of millions in assets. So that's a good sign. The next thing we can see is what's known as the current ratio. Current ratio is basically the current assets divided by the current liabilities. These are both present on the balance sheet. The term current is basically liquid. So what assets can be converted to cash very quickly, and what liabilities are going to be due soon. For me personally, when I see a company that's small and not yet profitable, I really want to make sure that the current ratio is higher than 1, preferably 4 or 5. In this instance, McEwen Mining, it's almost 10, which I think is a great sign for a company that's not yet profitable. Because one of the challenges, particularly in the mining sector, is for these small companies or ones that haven't fully matured yet, is do they have enough capital to sustain operations? Mining can be an expensive business. Current ratio is a way of identifying that. Price to book. So in this instance, we want to scroll down. You'll see total equity. That's the book value of the company. If you take the assets minus the liabilities, what's the value? So basically, if the company wanted to sell all its assets, all its mining equipment and property rights that it may have, that's the value you're getting at. So when you take market capitalization, which is the current market value of buying every share in the company, and you divide it by equity, you get a price to book ratio. That tells us, how much more of a premium are you paying versus the assets that the company actually has. Personally, these days, I like to see that number, 3 or less, but again, this is a relative number, so you want to see at what other companies. When you're looking at a whole bunch of companies, this is something to consider and help you identify which companies are underpriced. Lower price to book is a good sign. Of course, be selective. Just say no. Don't invest. Look for reasons to say no. That's about it. Join us more in the next video at informedtrades.com.